The illusion of free banking. Your bank account is not a gift. It is a trap.
Welcome, discerning financial connoisseurs, to another unflinching examination of the pecuniary labyrinth that governs our modern lives. Today, we peel back the polished veneer of convenience and trust that surrounds one of North America's most ubiquitous, yet often misunderstood, institutions, the commercial bank. Prepare yourselves, for we shall expose a pervasive myth, a grand illusion. Perpetuated with smiles and savvy marketing, the notion of free banking. Let no one be mistaken. Your bank account is not a magnanimous gift from a benevolent financial giant. It is, in fact, a carefully constructed trap, designed with surgical precision to extract maximum value from your hard-earned currency. This exposition will delve into the myriad hidden fees, the sneaky charges, and the subtly predatory practices employed by North American financial institutions. From overdraft fees that, with remarkable efficiency, target the most vulnerable among us, to account maintenance charges that silently erode savings like a persistent, unseen leak. Viewers will discover that banking is an enterprise rarely, if ever, characterized by genuine liberality. One will learn that true financial literacy often necessitates reading the fine print. That intricate tapestry of legalese and disclaimers that lawyers specifically crafted for invisibility, ensuring that the true cost of convenience remains shrouded in deliberate obscurity. This is not a tale for the faint of heart, nor for those who cherish blissful ignorance. This is for the critical analyst, the one who demands to know where the money truly goes.
The grand illusion. How banks market free and why you fall for it.
Let us begin by dissecting the very foundation of this illusion, the marketing. Banks, these colossal, often imposing edifices of glass and steel, project an image of unwavering stability, trustworthiness, and, dare one say, friendship. Their advertisements feature smiling families, diverse individuals achieving their dreams, all seemingly facilitated by a kindly bank employee who is merely there to assist. They promise security for your funds, effortless transactions, and unparalleled convenience through digital platforms that seemingly give you ultimate control. Bank with us for free checking, they proclaim, or no monthly fees with direct deposit. These slogans are not merely catchy. They're meticulously crafted psychological levers, appealing to our innate desires for security, simplicity, and, of course, the ever-elusive bargain. This psychological manipulation is masterful. Banks leverage the fundamental human need for trust, especially when it concerns one's life savings. They position themselves not as profit-driven corporations, but as essential partners in your financial journey, benevolent custodians of your wealth. They highlight the digital age's marvels: mobile deposits, instant transfers, biometric logins. All of this, they suggest, comes at no direct cost to you. The subtext is clear. We provide these invaluable services out of the goodness of our corporate hearts, because we care about your financial well-being. Many individuals genuinely believe their bank is helping them, providing an indispensable service without asking for much in return. This belief is precisely what allows the myriad hidden charges to flourish, unnoticed and unchallenged. After all, one does not question a gift, does one? One simply accepts it, perhaps with a murmur of gratitude, completely unaware of the strings attached, the small print clauses, and the subtle mechanisms designed to separate you from your money, one microscopic transaction at a time. The convenience they offer is indeed real, but it is a convenience that comes at a price you are almost certainly paying.
The overdraft fee fiasco. A tax on the vulnerable, disguised as a service.
Now, let us delve into one of the most egregious examples of banking's illusory generosity, the overdraft fee. This is a charge so remarkably predatory, so perfectly designed to extract maximum value from those least able to afford it, that it deserves a special place in the pantheon of financial chicanery. An overdraft occurs when you spend more money than you have in your account, rather than simply declining the transaction, as would be the sensible and financially responsible course of action. Many banks offer to cover the amount, effectively extending a tiny, extremely high-interest loan to you. For this service, they charge a fee typically ranging from $30 to $35 for each and every overdraft. Consider the mechanics of this operation. You attempt to purchase a $4 coffee, unaware that your account balance stands at $3. Instead of the polite refusal of your card, the bank in its infinite benevolence processes the transaction. Then, it slaps you with a $35 fee. Your $4 coffee has now cost you $38. This is an effective interest rate that would make a loan shark blush. Furthermore, banks often employ a practice known as reordering transactions. They process the largest transactions first, even if they occurred later in the day. This is not an arbitrary choice. It is a meticulously calculated strategy. If you have $10 in your account and make a $50 payment for rent, followed by 5 smaller purchases throughout the day, the bank will process the $50 payment first. This immediately puts your account into overdraft. Then, it processes the 5 smaller purchases, each now incurring a separate overdraft fee. Your single $50 mistake has now morphed into 6 separate overdraft fees, totaling $210, all for the low price of the bank covering your $75 in spending. It is a masterful system of automated financial extraction, a testament to the ingenuity of corporate profit maximization. This practice disproportionately affects low-income individuals and those living paycheck to paycheck, who are more likely to have fluctuating balances and occasional shortfalls. It is quite literally a tax on poverty. The Consumer Financial Protection Bureau, CFPB, has repeatedly highlighted how these fees represent a significant portion of bank revenue, often from a small segment of their customer base. It is a clear demonstration that the bank's primary objective is not to protect your financial health, but to capitalize on its fragility. Their courtesy is merely a thinly veiled opportunity for profit.
Account maintenance and minimum balance fees, penalizing the prudent.
Beyond the dramatic flourish of the overdraft fee, there exists a more insidious, yet equally effective form of wealth erosion, the monthly account maintenance fee. Imagine, if you will, paying a rental fee for the privilege of storing your own money in a secure vault. This is precisely what many banks charge for basic checking or savings accounts. These fees, often between $5 and $15 per month, may seem small in isolation, but they accumulate with relentless efficiency, silently chipping away at your principal. Over a year, a $12 monthly fee amounts to $144, an amount that could otherwise be contributing to your savings, your investments, or even a modest indulgence. Banks, of course, offer a labyrinthine series of conditions to waive these fees. Typically, one must maintain a minimum daily balance, often several hundred, or even a few $1,000s, or establish a direct deposit of a certain amount each month. The implied cost is clear. Either you keep a significant sum of money idle in your account, foregoing potential investment returns, or you ensure your employer funnels your income directly into their coffers. For individuals who struggle to maintain high balances, or whose employment situations make consistent direct deposits difficult, these fees become unavoidable. They are effectively penalized for not being wealthy enough, or for having less predictable income streams. Consider the absurdity of it. You're providing the bank with capital which they then lend out to other customers at interest, or invest for their own profit. For this invaluable service, they then charge you a fee. It is akin to a hotel charging you a fee for the privilege of them storing your luggage, which they then rent out to other guests while you are away. The service you are supposedly paying for is the basic functionality of a bank account, something that, in a truly competitive and customer-centric market, should be a fundamental expectation, not an added cost. This fee is a clear indicator that the bank views your money not as something to be managed on your behalf, but as a resource to be monetized, even if that means slowly draining it from your account.
The ATM fee extravaganza. Your money, their machine, your problem.
The modern financial landscape is littered with seemingly minor irritations that, upon closer inspection, reveal themselves as expertly crafted revenue streams. Among these, the automated teller machine ATM fee stands out as a prime example of charging you for accessing your own funds. Imagine for a moment that you need cash. You locate a convenient ATM, insert your card, and retrieve your money. Simple? No, not quite. Should that ATM belong to a different banking institution than your own, you are almost invariably subjected to a double whammy of charges. First, the owner of the ATM will levy a fee for the privilege of using their machine, typically between $2 and $5. Then your own bank, not to be outdone in the art of financial extraction, will often impose its own fee for using an out-of-network ATM, adding another $2 to $5 to the transaction. Suddenly, a withdrawal of $20 has cost you up to $10 in fees. This is a 25 to 50% surcharge for accessing your own money. The rationale? The cost of maintaining the ATM network, they will claim. A perfectly reasonable expense, one might suppose, until one considers the colossal profits banks generate. This system effectively limits your choices, subtly coercing you into using your own bank's ATMs, regardless of convenience. It reduces your financial autonomy, making spontaneous cash needs a costly affair if you are not near one of your own bank's designated machines. It is an ingenious method of monetizing an essential service, transforming a basic convenience into a continuous revenue stream. The humor in this situation lies in its sheer audacity. You are charged by your bank for not using their machine, and you are charged by another bank for using theirs. It is a win-win situation for the banks and a lose-lose situation for you.
Transfer and wire fees. The cost of moving your own funds.
In an age of instant digital communication and near instantaneous global information transfer, one might expect the movement of money to be equally seamless and, for the most part, free. One would, however, be mistaken, particularly when dealing with established financial institutions. Banks, ever keen to monetize every possible interaction with your capital, frequently impose charges for various forms of funds transfer. Consider standard bank-to-bank transfers, particularly if they are to an external institution or require a slight acceleration. While many basic electronic funds transfers (EFTs) are now free within North America, there remain circumstances where a bank may impose a fee for what it deems an expedited transfer or one to a lesser-known institution. The true masterpiece of this fee category, however, is the wire transfer. This archaic yet stubbornly persistent method of moving money is astonishingly expensive. Domestic wire transfers can cost between $25 and $35 per transaction, and international wires can easily run $45 to $50, or even more, depending on the destination and the intermediary banks involved. The stated rationale for these exorbitant fees often involves the security and speed of the transaction, and the manual processes involved. Yet, in an era where blockchain technology can move billions of dollars across continents in minutes for fractions of a cent, the continued imposition of such steep fees for what is fundamentally an electronic message seems less about genuine cost and more about extracting maximum value from a captive market. It is a convenience tax on those who require prompt, secure movement of significant sums, or those who simply do not wish to wait days for an ACH transfer to clear. The irony is palpable. You are paying a hefty sum for a service that technologically should be far cheaper. A relic of a slower, more cumbersome financial era, yet priced as if it were a bespoke luxury offering. The banks, with a straight face, will tell you that the cost is justified. You, the astute observer, will recognize it for what it truly is: another toll gate on the highway of your money.
The international transaction tax. When your money travels abroad, it pays a tariff.
As the world shrinks and global commerce becomes commonplace, one might assume that using one's own money across international borders would be a straightforward and cost-neutral affair. Fortunately, this assumption often leads to a rude awakening, courtesy of the international transaction tax levied by North American banks. This particular fee often manifests in two primary forms, ensuring that your funds accrue extra costs simply by crossing an imaginary line on a map. Firstly, most debit and credit cards issued by traditional banks impose a foreign transaction fee. This is typically a percentage of the total transaction amount, ranging from 1 to 3%. While seemingly small, these percentages accumulate rapidly. A $1,000 vacation abroad, paid for entirely with your plastic, could silently incur an extra $10 to $30 in fees. This is not an exchange rate conversion fee. It is an additional charge for the privilege of using your card internationally. It is a tariff imposed by your own bank, designed to profit from your global movements. Secondly, beyond the explicit transaction fee, there is often an implied markup on the exchange rate itself. While banks will use a competitive wholesale rate for their own operations, they frequently apply a less favorable retail exchange rate to your transactions, effectively building in a small profit margin. This makes it challenging to ascertain the true cost of your international purchase, as the fee is baked into the conversion rate, rather than appearing as a distinct line item. These hidden costs add up quickly, whether you are traveling for leisure, conducting business internationally, or simply shopping online from a foreign vendor. They demonstrate a bank's ability to monetize almost any permutation of your financial activity. The banks, of course, justify these fees by citing the costs associated with international payment networks, currency conversion, and fraud prevention. While these costs exist, the markups and explicit fees often far exceed the actual expenditure, serving instead as yet another robust revenue stream. It is a classic example of an oligopoly dictating terms, where the consumer, in need of a universal payment method, has limited alternatives that are truly fee-free. One's money, it seems, becomes less valuable simply by crossing a border, not due to market forces, but due to institutional decree.
The not-so-subtle sales tactics, cross-selling and upselling.
One of the more unsettling revelations for the average consumer, when they finally pull back the curtain on banking operations, is the realization that their friendly neighborhood banker is, in essence, a salesperson. Traditional financial institutions are not merely passive custodians of your funds. They are highly aggressive sales organizations with quarterly targets, performance metrics, and a plethora of incentives designed to push additional products and services. This is where the illusion of personalized financial advice often collides with the stark reality of corporate profit motives. Bank employees, from tellers to branch managers, are frequently tasked with cross-selling and upselling. This means encouraging existing customers to open new accounts like savings, checking, money market, apply for credit cards, take out personal loans, set up investment accounts, or enroll in various insurance products. The pressure on staff to meet these sales quotas can be immense, leading to situations where products are recommended not because they are genuinely in the customer's best interest, but because they contribute to the employee's bonus or job security. Anecdotes abound of individuals being subtly, or sometimes overtly, pressured into products they do not need or fully understand. A customer opening a simple checking account might be asked about their need for a credit card, or a home equity line of credit, or even a basic investment portfolio. This often occurs under the guise of providing comprehensive financial solutions, or optimizing your banking relationship. The humor, if one can find it, lies in the earnest delivery of these sales pitches, often by individuals who themselves may have limited understanding of the complex products they are peddling. The illusion here is that of objective, unbiased advice. When you speak to a bank representative about your financial needs, you are not engaging with a fiduciary whose sole obligation is your best interest. You are engaging with someone whose job performance is tied to generating revenue for the bank. This is a critical distinction, and one that is often deliberately blurred. The personalized advice you receive may well be tailored to your financial profile, but its ultimate objective is to extract more value from you, not necessarily to optimize your personal wealth outside of the bank's ecosystem. This inherent conflict of interest requires an extraordinary level of vigilance from the consumer. One must always remember that in the world of banking, everyone has an agenda, and your best interests are rarely the primary one.
The fine print follies, where lawyers earn their keep.
For the critical financial analyst, the term fine print is not merely a colloquialism. It is a battleground. It is the place where the illusion of free banking is systematically maintained through the deliberate obscuring of crucial information. Bank terms and conditions, account agreements, and fee schedules are not designed for clarity. They are, in fact, masterworks of obfuscation, meticulously crafted by highly compensated legal teams whose primary objective is to protect the institution's interests, maximizing its revenue opportunities, all while ensuring legal compliance, however tenuous. These documents are often lengthy, dense, and replete with highly specialized legal and financial jargon. They are presented in small fonts, sometimes online requiring endless scrolling, and are usually offered at a moment when the customer is focused on opening an account, not on scrutinizing a multi-page contract. Who in their right mind takes an hour to meticulously read every clause of a new checking account agreement? Very few, and the banks count on this pervasive customer behavior. They understand that the average person possesses neither the time, patience, nor the legal expertise to fully comprehend the implications of every single clause, every single definition. The strategic use of legalese serves a dual purpose. Firstly, it provides a legal shield, allowing the bank to point to the fully disclosed terms whenever a customer disputes a charge or uncovers an unexpected fee. "It was in the agreement you signed," they will assert, with an air of unassailable rectitude. Secondly, it creates a formidable barrier to understanding, ensuring that the true cost structure, the various penalties, and the bank's rights remain largely opaque to the typical customer. It is a deliberate act of information asymmetry, where the institution possesses a wealth of detailed knowledge, while the individual is left largely in the dark. The humor in this situation is admittedly quite dark. Imagine receiving a gift, only to find that the wrapping paper contains a 20-page contract outlining all the ways the gift giver can reclaim their benevolence, or charge you for the usage of said gift. This is, in essence, the experience of free banking. The lawyers who draft these documents are not merely wordsmiths. They're architects of financial invisibility, ensuring that the critical details remain hidden in plain sight, protected by a fortress of unintelligible prose. Their success is measured not by how clearly they communicate, but by how effectively they obscure
The digital disguise, online banking fees, and hidden data charges.
In an increasingly digital world, online banking has become not merely a convenience, but an expectation. Banks proudly tout their sleek mobile apps, user-friendly websites, and the ability to manage your finances from anywhere at any time. This, too, is often presented as a free service, an added value that costs you nothing. And for many basic online functions, it is indeed true that there are no explicit fees. However, the illusion of cost-free digital banking can be misleading, particularly when one considers the broader picture of modern commerce. While direct fees for checking your balance or paying bills online are rare, some banks may have charges for specific advanced features, such as expedited online bill payments to certain vendors or perhaps for extensive historical data access beyond a certain period. More significantly, in the digital realm, if you are not explicitly paying for a service with money, you are often paying for it with data. Banks, like many digital platforms, collect vast amounts of information about your spending habits, transaction patterns, and even your online behavior within their ecosystem. This data, anonymized and aggregated, can be incredibly valuable for market research, targeted advertising, and even for developing new financial products tailored to perceived customer needs. While this is not a direct monetary fee, it is a form of value exchange that often goes unacknowledged by the consumer. Your financial life and its digital manifestation becomes a data point, a statistical input in their ongoing quest for profit optimization. Furthermore, the convenience of online banking can sometimes lead to a false sense of security or control. The ease with which one can transfer funds or make purchases might inadvertently lead to less diligent tracking of balances, thereby increasing the likelihood of incurring those ever-present overdraft fees. The digital disguise, while offering undeniable benefits in terms of accessibility and speed, can also serve as another layer of camouflage for the underlying profit-driven machinery of the banking sector. The technology may be cutting edge, but the underlying motivation remains as old as money itself, to make more of it, ideally from you.
Actionable advice: escaping the banking trap.
Having thus exposed the intricate mechanisms by which banks monetize your money under the guise of providing free services, it is now imperative to equip you with the knowledge and strategies necessary to navigate this treacherous landscape. One must move beyond passive acceptance and embrace proactive financial self-defense. The goal is not merely to complain, but to outwit, to outsmart, and to minimize the tribute you pay to these financial behemoths. 1. Read the fee schedule with the scrutiny of a forensic accountant. This is the most fundamental piece of advice. Do not simply nod along when opening an account. Request the comprehensive fee schedule for every account type you consider. Read it. Understand every charge: monthly maintenance fees, overdraft fees, ATM fees, foreign transaction fees, transfer fees, early account closure fees, dormant account fees. Question anything you do not comprehend. 8. If it is not immediately clear, ask for clarification in writing. These documents are your map to avoiding financial pitfalls. Treat them as such, not as an afterthought. 2. Master your account balance. No more overdraft surprises. The simplest way to avoid overdraft fees is to know precisely how much money is in your account at all times. Utilize your bank's online portal and mobile app religiously. Set up low balance alerts. Consider linking a savings account to your checking account for overdraft protection. But be aware that some banks may still charge a small transfer fee for this service. Better yet, simply ensure you always have a buffer. Remember, an overdraft fee is 100% avoidable through diligent management. It is a penalty for a lack of vigilance and a completely unnecessary expense. 3. Explore credit unions and online banks. Alternatives to the big bank monoliths. Traditional commercial banks are not your only option. Credit unions, as non-profit organizations owned by their members, often have significantly lower fees, better interest rates on savings, and more customer-centric policies. Online-only banks, unburdened by the overhead of physical branches, can also offer highly competitive, often truly fee-free, checking and savings accounts. They may even reimburse ATM fees from other banks. Research these alternatives. They represent a powerful means of opting out of the traditional banking trap. 4. Automate your savings. Build your buffer. Starve of their fees. Set up automatic transfers from your checking account to a separate savings account, ideally at a credit union or online bank, immediately after your paycheck arrives. This not only builds your emergency fund, making you less susceptible to overdrafts, but also reduces the average balance in your checking account. It's potentially making it easier to meet minimum balance requirements without keeping excessive funds idle in a low-interest account. Automating savings removes the temptation to spend and systematically fortifies your financial position. 5. Do not be afraid to negotiate fees. The worst they can do is say no. If you are hit with a fee, particularly an overdraft or a monthly maintenance fee, call your bank and politely yet firmly request that it be waived. If you have a good banking history, a long-standing relationship, or if it is your first offense, many banks will waive the fee as a gesture of goodwill. Persistence and politeness can often save you $35. They do not want to lose a customer, and a simple phone call is a low-cost way for them to retain your business. 6. Utilize free alternatives for transfers and payments. For person-to-person payments. Explore applications like Zelle, Venmo, or PayPal, which often facilitate immediate transfers without fees. As long as you are transferring between accounts within the same country. For bill payments, most banks offer free online bill pay services. Ensure you are using these instead of any paid options. For international money transfers, explore specialized services that often offer significantly lower fees and better exchange rates than traditional banks, though always compare rates and security features. 7. Question every charge. Your money deserves due diligence. Never accept a fee at face value. You see a charge on your statement that you do not recognize or understand? Question it. Call the bank. Demand an explanation. Understand why it exists and if it was avoidable. This vigilant approach not only protects your current funds but also educates you on the bank's policies, making you a more informed and powerful consumer. This is your money. You are its primary defender. 8. Monitor your statements with diligence. Review your bank statements monthly, or even more frequently through online access. Look for unauthorized transactions, errors, and, crucially, all fees charged. Banks do make mistakes, and sometimes unauthorized activity occurs. Your diligent review is your first line of defense against these issues. It helps you stay aware of how much you are truly paying for your banking services.
The verdict? Your money, your vigilance.
In summation, the illusion of free banking is a masterful construct. It's meticulously designed to make you feel cared for, while simultaneously creating numerous avenues for profitable extraction from your funds. Traditional banks are complex businesses, and their primary goal, like any corporation, is to maximize profit for their shareholders. Your convenience, security, and financial well-being are secondary considerations, always subordinate to that ultimate objective. This knowledge should not breed cynicism, but rather empower you to become a more astute, more critical financial analyst of your own life. By understanding the banking trap, its lures, and its mechanisms, you can proactively choose alternatives, modify your behavior, and demand greater transparency and fairness. The days of blindly trusting your bank are over. They should never have begun. Reiterate the importance of critical financial analysis. Empower viewers to be proactive and informed consumers. Your money is a precious resource. Treat it with the respect it deserves. Do not allow it to be silently siphoned away by institutions masquerading as benevolent partners. The only true path to financial freedom in this complex landscape is constant vigilance, continuous education, and an unwavering commitment to protecting your own interests. Now, go forth. Arm yourselves with this knowledge. May your accounts remain robust, unmolested by the invisible hands of institutional fees. Enjoy your free banking, if you can still call it that, with your eyes wide open. Do you possess an untold horror story of bank fees? A particularly audacious charge that defies common sense? Share your critical insights in the comments. Your experiences illuminate the path for others. Furthermore, click that subscribe button and ring the notification bell. Join our growing community of discerning individuals who refuse to be passive victims of financial chicanery. We are here to arm you with knowledge, one inconvenient truth at a time. Do not let ignorance be your financial downfall.